Hey, accounting students, this is your teacher Roy with our semester's first chapter video. That's chapter number one. So, probably most chapter videos will probably divide up into two parts. So, this is part one of two. Here for chapter one, dealing with the equity method of accounting. That's for asset investments. Okay, so we're going to be increasing and decreasing this investment account, this asset account. So, what's the motivation of a corporation buying another company? Well, maybe it's a temporary investment to park our idle cash. Most large businesses, most large corporations may have a treasury department. One of the responsibilities of the treasury is to make sure they have enough cash on hand. And of course, they always want to have a balance, not to have too much. If they do have excess cash, they probably want to park it even overnight into some type of fund that's not risky, like a money market fund with government um, bills or notes underlying the investment. Even though we're dealing with a small amount of interest percentage, if it's being invested in the amounts of millions of dollars, you're dealing with big bucks, yeah? But if you want to invest in a longer term in buying another company, that's really what we're focusing on here in this chapter number one. Now, keep in mind, all of you guys took intermediate accounting in a previous chapter where you learned about accounting for investments, typically for trading or for available for sale. But again, here in this chapter, we're kind of buying another company to have influence over them. So to collectively, our company and the target so-called investee, where we are the investors, can maybe get leverage in magnifying the earning capabilities of both companies. So there's different methods of accounting depending upon how much influence and how much control one company has over another. Before we move on, let's kind of analyze investments again. So way back in your first accounting class, you learned about, let's see, my pen here. You learned about assets, everything the company owns are equal to the liabilities the company owes. And assets minus the liabilities are equal to the equity. Or sometimes you hear the term book value of a company, net book value. That's the same thing as the equity. Or sometimes in our governmental accounting class, if you took it in a previous semester, we learned about the term fund balance or net assets. That's this part of the accounting equation. And we know we have to stay in balance. Of course, everybody knows, even non-accountants knows about a cash asset, our favorite asset. But now, here in this chapter one of our class, we're talking about another investment, another asset called investments. And basically, we're buying stock of another company. And depending upon how much control, how much um, influence we have over that investment company, will determine the accounting method we use in increasing or decreasing this investment asset account. Keeping in mind that we want our company to be profitable. And if our asset is profitable, we're going to be profitable. Again, increasing this asset account. If our investments go down in value or lose money, then this asset has to decrease in its balance. And of course, drill into our heads, asset increase with debit, right? Well, at the same time, what are you crediting? Or if we go down in value, crediting the investment asset. At the same time, in the same journal entry, what are you debiting? Well, we learned about, of course, revenue and expenses on our income statement versus the accounting equation on our balance sheet. So here's our net income. And if our investment is profitable, we're going to share in that profit, increasing our revenue, increasing our net income, which is eventually closed out into the retained earnings account, increasing equity, and thus increasing our investment. Or if our investment runs a loss, either decreasing revenue or increasing expense, decreasing net income, again closed out to our retained earnings, reducing equity, reducing the investment, overall reducing assets. Now the question is how much and when do we do it? That's really the bulk of this video and this chapter. There are four different methods mentioned here of accounting for investments. Really, this first two kind of go together. And then the bulk of our chapter one deals with this equity method. And after chapter one, the next four chapters, chapters 2, 3, 4, 5, deal with this consolidation method. The method that you use generally depends upon how much influence and how much control our company, the investor, we're taking the viewpoint of the investor, has over the investment, a stock we're buying in from the investee. The less influence we have, the less control, then we use this method here. A moderate amount of influence, really significant influence. Here is the method we're learning now in chapter 1. And then if we have control, meaning more than half of the ownership of the investee, we're going to learn to consolidate all the different companies together in one set of financial statements. Again, that's future chapters from chapter 1. Again, small ownership. That's the first, let's go back. This first method called fair value. Yeah. Relatively small ownership. Small, typically in objective terms, amounts, is less than 20% ownership by the investor in the investee company. And because it's so small, our investor doesn't have significant influence over the investee company. We're told here that if the investee pays dividends to the investor, we just treat it as income to us, income to the investing company. Also, if the investment company increases in value, then we're also going to report income, both again for dividends that eventually the investing company will receive, or increase in the investment, again in the investing company's stock of the investee company. We'll go through an example in a few slides from now. So again, sticking with this fair value method when we don't have significant influence. Again, not present, yes, significant influence. We're going to record the initial investment at its cost, whatever you're paying for it. But whenever our investing company needs to prepare a financial report, a financial statement, we have to update all of our accounts, including our investment account. And if you look at the investment account, right now it's still recorded at its original costs. So now, at the end of our accounting period, or again, whenever we need a financial statement, we're going to adjust that investment account to its so-called fair value. Fair value is easy to determine if your investee's company stock is being traded on a stock exchange. You just look at the closing price on the date you need to get that value, and that's what you would adjust your course either up or downwards toward. It mentions here on this same slide, whenever that investee company declares a dividend, now our investment company, our investor company, has the right to collect that money. And under the accrual basis method of accounting, we don't wait to collect the dividend to report to income. We report income when earned, or when the performance obligation is completed, right? So usually that's typically when we have the right to receive the dividend, and that is reported as income. Okay, you don't adjust the cost of the investment for any dividends that you're going to be receiving. What you're adjusting the investment account is up to its fair or even down to its fair value. It's not the fair value, the investment account is not affected by any dividends. Now, if you cannot get a fair value, maybe the stock is not exchanged on a stock exchange. What we're going to do is just keep the investment at its original cost. We'll still record dividends whenever they're being declared, but you don't adjust the investment account because you don't know its fair value. Now, if you think that your investment is impaired, you probably got to write it down. Now, how do you get the value to write it down if it's not readily determinable, the fair market value? Well, you got to do your best guess. Here it mentions in item 2, maybe you know the value of a comparable company and you can adjust the valuation of that comparable company to your investee company, adjusting it up or down. Again, permanent change, really adjusting it down, a permanent um, impairment. You're going to have to report a loss, debit loss, credit that investment account to write it down. On the other extreme, now if you have more than 50% ownership in the investee company, not only do you have substantial influence, you have control over that investee company. And we're going to learn beginning in chapter 2, the method of accounting we use is called consolidation. Yeah, combining all of the companies together when we prepare one set of financial statements. And just like in that governmental accounting class some of you took in the previous semester, we had all the different governmental funds. And then when we prepared a government wide financial statement, we consolidated all of those funds together. So we'll learn about some adjustments or eliminations in future chapters after this chapter number 1. In addition to into taking into account the ownership, we may need to look at also any type of special contracts between the investor and investee company where they can actually control what's happening between the companies. Here it mentions special purpose entities maybe trying to hide assets or hide liabilities, so-called off-balance sheet financing. And the purpose of all of these rules we're learning, most of the rules we're learning in our class, is to make things more open, uh, especially if you do have this type of entities. Okay? So no hidden assets or liabilities. And the method we're focusing on here in our chapter number 1 is the equity method. Again, at one extreme was the fair value or cost method. At the other extreme was the consolidation method. And the middle ground here, meaning between 20 and 50% ownership, is this equity method. Now, again, if it was less than 20%, the objective measurement says that you probably use the fair value method. If more than 50%, you would use the consolidation method. So within this 20 to 50% range, now we're saying we have significant influence. The investor has significant influence over the investee company. And we'll learn most of the adjustments in both this first and second video for the equity method. One thing it mentions in the last item, if you have dividends, not received but declared, what you're going to do is not report any dividend income like you would for the fair value method. What you're going to do is reduce the investment asset account increase dividend receivable or cash if you got the cash dividend, and decrease credit the investment account. Okay, not reporting any dividend as income to the investor. Again, if this equity method applies. So let's learn the accounting rules for the equity method. What do you increase? What do you decrease? How much do you increase or decrease it by? And eventually using debits and credits. When you do have that 20 to 50% ownership, now you can probably vote for people to put on your board of directors, your people on their board of directors. So now you have some say in the policy making decisions of the investee company. And you may be able to control the types of transactions between the investor investee, possibly even setting certain prices you sell things at or buy things at. And also, that means eventually controlling the profit on those transactions. If you have influence over the investee company, maybe you also can now hire people in the management of that company or even transfer management from the investor to the investee company. This one is a little tricky here. Um, when you have two companies pretty much merging together, what you want to do is increase your efficiencies by eliminating costs, not just necessarily increasing revenue, but decreasing costs. For example, here in Hawaii, most of us know about the Hawaiian Airlines merger with Alaskan Airlines. And most of the employees in Hawaii kept their jobs in this merger. But the people that probably are or have lost their jobs already are people like us, accountants, because we're kind of like overhead. And the reason for that is the accounting personnel in Alaskan Airlines, through technology, have a leverage in doing even more work, taking over the work of Hawaiian Airlines. Okay? Again, because of technology, you don't need more accountants anymore when the company is combined together to form a bigger company. And the last criteria here mentioning for equity and even the other methods, what's the ownership that you don't own, other people owning in that company? Is it really a whole bunch of different people and they cannot get organized in terms of manipulating, controlling the company? Or is it owned by a few individuals that together now can organize their control over that investee company? And of course, for every good thing about a rule, there's also bad things or here limitations. Um, I'll let you read this on your own, but let's move on to more examples or transactions. Again, they talk about the ownership other than yours, yeah, that if they hear majority ownership, that you're the minority, yeah? And if the majority is owned by few individuals, they pretty much can dictate what happens in that company. Again, if it's owned by a lot of individuals that are not organized together, then you, with less than 50%, could be able to control that company. Again, pretty much we'll stick with that less than 20, 20 to 50, and more than 50 to determine whether we use fair value, equity method, or consolidation. This table is kind of messed up. So to get a better description of the summary of all these methods, I recommend that you look at the table in your textbook. So let me see if I can fix this up here. I need to get back to my cursor. My cursor. I can't get my cursor on this screen. Let me go back in the previous screen. So here we had the three categories: less than 20%, 20 to 50%, and more than 50%. So when you have less than 20%, the assumption is that you do not have any influence or significant influence. If you have 20 to 50%, then you do have significant influence over that investee company. And if you're more than 50%, you're going to be able to control that investee company. The investor can control the investee company. So the three different methods of accounting for the investment, if it's less than 20, we call that fair value. Now, if you cannot get that fair value, then you keep it at cost. Well, cost method. And then the bulk of our chapter one deals with this second one, the 20 to 50%, or so-called, it says fail here, should be um, not fail value, but fair value. So 20 to 50% is the equity method. Now, an option that we'll see maybe in the second video is not to use this equity method for the second group here, but revert back to this fair value method. And then if you have control, more than 50% ownership in the investee, again, we combine all the different companies together to form a consolidated financial report. In addition to these percentage limits, there may be control factors outside of owning stock, including things like contracts that may affect control. Yeah, that will determine whether, again, which one of these methods you would use. Let's go back to the slideshow here. So let's take a look at an example including debits and credits, the journal entries. Let's move on here. So here's an example. We have Big, that's our investor, purchasing a 20% interest in Little, that's our investee, at the beginning of 2023. And the price being paid is $210. Then we're given the profit, the net income of our investee for the next 3 years, $200, $300, $400,000. So if our investee Little is profitable, that means our investor Big should share in that 20% of the profits. You notice, remember, we talked about less than 20, 20 to 50, and over 50. So this 20 is right on the borderline. Even though this is labeled to be the equity method, we're going to also take a look at how would you treat all these amounts using the fair value, where you don't have any significant influence. Okay? Or if you do, then we use the equity method. Okay, we'll look at both situations. In addition to the profits of Little, we're also given the amount of dividends that were not paid but declared over those same 3 years. So Big, as a shareholder, should get 20% of this in the first year, 20% of this in the second year. Here, $40,000 worth of dividends in for the third year. And another factor we're given is how much the investment Big has in Little is worth the so-called fair value. Here they call it market price. At the end of those same 3 years. Remember, we bought it at 210 and it's increased in value to 245 at the end of the first year, 282 at the end of the second year. Okay, the trend looks good. 325 at the end of the third year. How does this affect what Big records as profits and the cost basis, the balance in its investment account? So to make things a little bit more easy to see on one page, here is a summary of the amounts. And again, there's mistakes on this slide. Again, refer to our textbook. Our video lectures is not a substitute. Yeah, it's a supplement to our textbook. I would recommend you watch the video first so you get used to the terminology, and then you have an idea now when you do read the textbook more in detail, overall details that you won't be able to memorize, but you will be able to get a concept. So eventually, when you do the homework and do take the quizzes, you can always refer to the correct section in the chapter versus trying to search the whole chapter. You know, saves you time. Okay, so just overview here. And the error, I think, let me see if I can get my pen here, is in this column. You ignore this. They just duplicated this previous um, this previous column over here, yeah? So this last column, I'll show you the correct amounts. In fact, now we have two different methods. One is fair value, where we have no significant um, influence over the investee, and one where we do have significant influence, but no control. Remember, if you have control, you got to use that third method, the consolidation method. And the results can be divided up into these two parts here. Again, fair value and equity method. We're given the years here in the first column. Let's see if I can get my pointer back. Here in the first column, and then the income. This is all of the income of our investee company. Keeping in mind we own 20%. Let me go back and double check that. Yeah, 20% of the investee. So 20% of this income really belongs to the investor, the profit. Yeah, 20% of this, 20% of this. Okay. So let's say that, again, we do not have any significant influence. That means whenever there's dividends declared by the investee, our investor has to report this as income. 10,000 of dividend income from the investee in the first year, 20% or 20,000 in the second year. Again, the 20% of this number here, yeah? 20% of this number in the third year. Let's see, that would be crediting dividend income, so like any other income or revenue being credited. Now, what would you debit? Remember, we're doing this at the time the dividend is being declared and not received in cash. Yeah, so we're probably debiting dividend receivable. And then later on, when we do collect it on the receivable, that's when we debit cash and get rid of crediting the dividend receivable account. Again, that's fair value. If you read the previous slide or read the textbook, under the equity method, you do not record this as income. You still record the dividend receivable, debit. Now, what do you credit at the same time? What you're going to do is credit the investment account. Investment is an asset. When you credit an asset, you're reducing the asset. So basically, when you're using this equity method and you're going to get a dividend, you're going to increase cash or increase dividend receivable and decrease another asset, the investment account. Okay? That's not the same way as the fair value method when you do not have significant influence. There you record income. Going back to this fair value, there's another income you got to report, and that's the increase or decrease in the value of your investment. We were told that, well, let's go back and put in the costs. So my pen here. The original cost when you bought the investment was $210,000. At the end of the first year, it's now increased to $245,000. That's an increase of $35,000. This is income for the first year, the increase in value from its original carrying amount to the end of the year. In addition to, of course, the 10,000 we already recorded for dividends. The value of the account increased to 282 for the second year. Your starting point for the second year is 245. So that means it increased by 37,000 in the second year. Again, we're increasing the investment account by these amounts, debiting the investment. Now, at the same time, what are you crediting? You're crediting some type of revenue, increase in equity value, increase in investment account, yeah, for these amounts, debiting the asset to increase the investment. Again, this is fair value method. Let's go again to the equity. The equity method, we said we ignore dividends as income. We don't ignore the dividend, but it's not treated as income. You know, it's treated as a reduction to the investment account. So again, let's start off with the same cost, 210, the purchase price. And when we get this 10,000 of dividend, what we're going to do is reduce that investment by $10,000. Whenever you get a dividend, you're going to reduce it, the investment by that amount of dividend. Just exchanging the dividend for your investment. But because you have significant influence over your investee company, whatever they earn, part of that is yours. In our case, 20% ownership. 20% of this 200,000 is the 40,000 you see over here. And that has to be added to your investment. Okay, remember how we subtracted the dividend? Well, now here you're adding it to the investment. So the net, starting off again with 210 minus 10 plus 40, I believe it gives you a ending balance of 240,000 in your investment asset account at the end of the first year. Sorry for my bad handwriting, but you'll see this 240 in the textbook. So that's your starting point for the second year. You're going to decrease it by the dividend you receive for the second year. You're going to increase it by 20% of the investee's net income for the second year, resulting in a new balance. That's also going to be the beginning for the third year. Decrease by that year's dividends. Increase by that year's share of the net income, resulting in the new carrying value at the end of the third year. This footnote is probably wrong if that last column is also wrong. Again, take a look at your textbook to see how much is the balance and how you adjust it to get the amount you're showing on your financial statements at the end of the year for that investment asset under the equity method versus fair value method. Again, usually less than 20%, right? And 20% or up to 50% for equity. Now, what's accounting without general journal entries, debits, and credits? So let's journalize this adjustments right here for the first year under the equity method. Remember that 40,000 share? That's 20% of the investee's income. Well, that's income to you, the investor. We're crediting our income account, making it bigger. Now, what are we debiting? It's the investment asset itself. Debit asset making asset bigger. Also keeping in mind, remember that $10,000 dividend? It's not income. Here, we get the dividend, or we're going to receive the dividend, receivable, but we reduce the asset, not increase income, but reduce the asset, crediting the asset going down. And here is just the collecting of this receivable down here. It doesn't affect any of the investment or the income. Okay. Equity method. Let's go back to the initial purchase of the investment. So if you look at the investee, here's the assets owned by the investee and the liabilities owed by the investee and the equity owed by the investee. Now, if all these numbers were accurate and up to date, how much would you pay for this investee company? The whole company now. You're not going to pay this because now you owe money. What you're going to pay to buy this investee company is this amount right here, assuming that all of the assets are properly reported by the investee. all the liabilities are properly reported by the investee. And the tendency when you prepare your financial statements is to be conservative, right? We learned that term throughout all our accounting classes. And conservatism is kind of defined in a negative way that you do not want to do this. You do not want to overstate your assets. You do not want to understate your liabilities, resulting in you do not want to overstate, do not now want to overstate your equity. But so, many times assets are understated. So what we got to do is look for assets that are not reported or undervalued and thus affecting the equity. You may be willing to pay more than this equity amount. We call this amount here the book value of the company or the net assets of the company. And if everything is properly recorded, then this is what you would pay to buy the whole company. But we probably have to revalue those assets. Some are probably understated, especially here in Hawaii. If you have a old company that owns real estate and they're recording that asset at cost, you know that asset is understated to its true current market value. And that eventually means you probably have equity being understated because the asset is understated. Again, so why would an investor pay more than that book value we just saw? It's probably because there's some hidden assets. And those hidden assets are going to make the investee more profitable, if not now, in the future. So, what assets could be understated? I mentioned real estate, but here some specific ones are also inventory. If you remember in your first accounting class, we did the cost of goods sold calculation using average, FIFO, and LIFO. And during periods of inflation, a lot of companies like to use the LIFO method because for income tax purposes, they get to deduct the latest higher costing purchases, reducing their profitability and paying less taxes. But by doing that, on your balance sheet, what you're keeping as your inventory asset is the old, cheaper costs, lower costs of inventory, understating the true value of the inventory. Or in the case of depreciable assets, it mentions that straight line. Straight line is usually the main way we depreciate assets, at least for financial purposes. But possibly what could make the asset understated is that it took a short life, and the life of the asset is really longer than we had initially estimated. So maybe that accumulated depreciation is overstated, resulting in a book value that's understated. Maybe this asset should be lasting a longer life than we had initially projected. We took too much depreciation. Book value is too small. The whole value of the whole asset is bigger. The whole value of the company is bigger. So what we gotta do is identify these assets that are probably undervalued, and possibly adjust the profit we just recorded in the previous entries by those undervaluations. Let's take a look at an example here. We have the investor Grande buying a 30% interest in the investee Chico. This is Chico's accounting equation balance sheet. Assets of $500,000 are equal to liabilities of $300,000. So the difference is a book value or net assets or equity of $200,000. Now, if these assets are undervalued, that probably means this book value is undervalued. Right now, we're told that the equipment included in this 500,000 of assets is undervalued by 60,000. And then there's another asset, a patent or patents, also undervalued by 40,000. So the true amount of value of assets is not just the half a million, but you got to add another 100,000 or 600,000 is the total amount of assets. And to keep our accounting equation in balance, we're assuming liabilities don't change. So the only other thing to change in the accounting equation is to increase this equity also by 100,000 or 300,000. In other words, if you were to purchase the whole company, you're not going to pay 200, you're going to pay 300,000. And we're not buying the whole company, we're buying 30% of the company, the investee. So here, 30% times 300,000 gives us a purchase price of $90,000 we're willing to pay for that 30% interest. So let's look at the numbers again. Here's our purchase price, and the book value we're buying in the accounting records that have not been adjusted is 30% of the equity, or 60,000. That means we're paying 30,000 more than the book value for that 30% interest. Why are we doing that? Because there are assets that are undervalued. 60 for the whole amount of equipment and 40 for the patents. Keeping in mind, as the investor, we only own a 30% interest, which comes out to 18 for the equipment and 12 for the patents. And now here's that extra we're willing to pay for that 30% interest. Not the 60,000 net book value, but a $90,000 of value we're paying. There's no more value we're paying in excess of these identifiable assets. We don't have any so-called infamous goodwill asset. Yeah, right now it's zero. But let's say we really think this investee company is going to be worth even more. We still go through the same calculation. Here we're willing to pay $125,000, still for that same 30% interest and that same 200,000 of equity. Or we paid in excess of 65,000 over our share of the book value. We still have those same two identifiable assets totaling 30 for that 30% interest. So we paid extra to unidentified assets, and we allocate that now to the goodwill asset. Now, and it could be things like, good customer relations that, a lot of times most service companies are buying. They're not buying the hard assets like plant and equipment because they have excess capacity already. We want to buy your customers. We want to buy your quality employees. And there's no asset like that quality employee asset. We just throw it into a goodwill asset that will sit on your books until either there's an impairment to the whole value of your investment or when you just sell the whole investment. Okay. In the case of this additional costs allocated to depreciable or amortizable assets, what we gotta do is reduce the profitability, the investor's profitability by their share of additional depreciation and amortization. So here on this next schedule, you can see that excess we paid and the remaining life of the equipment, 10 more years. So that means we as the investor should recognize 18 more hundred of depreciation or 2,400 of amortization, or a total more expense costs or really reduction in the investee income of $4,200. Keeping in mind, this is not the investor's equipment or investor's patent, it's the investee's equipment and patent. but it's the additional cost that's going to benefit the investor over these amount of years. Thus, we got to allocate costs for that usage of 4,200. Journal entry. We're going to reduce the income from that investee. Remember, this is on the investor's books, or increase the loss of the from the investee, and here reduce the asset itself, the investment. Again, this is an adjustment we're making on the books of the investor whenever we paid for more than the net book value of in the investee company. Let's see. International financial accounting standards, yeah? The rules here are pretty much the same as our US GAAP, yeah? The 20% limit. So this is the end of the first video. In our second video, we'll go into more details about the equity method for specific situations like these listed here. Okay, so move on to the next video.